All right, welcome to Chapter 13, Problem Assignment Help. We are going to go over the homework. We have a handful of problems on this chapter, so let's go ahead and jump right in. On October 1st, Eder Fabrication borrowed $60 million and issued a 9-month, 12% promissory note. Interest was payable at maturity. Prepare the journal entry for the issuance of the note and the appropriate adjusting entry for the note at December 31st at the end of the reporting period. So let's go ahead and report the first one here. We're going to debit cash, credit notes payable. And we're going to do that for 60 million. So 60 and a lot of zeros afterwards. 1, 2, 3, 4, 5, 6. 1, 2, 3, 4, 5, 6. And then we're going to do the second one, which is to record the appropriate adjusting entry at December 31st. Let's go ahead and do this calculation wise. So we have 63, 4, 5, 6 times 0.12. And then we're going to take that amount and we're going to divide that by 3/12, which is 1/4. So I'm going to multiply that by 0.25 because that is the decimal form of that. And I get $1,800,000. So we're going to debit our interest expense and interest payable. What was it? 1.8? Yeah. All right, let's check our work. Sweet. All right, there you go. Next question. All right, on July 1st, Orcus Lab issued a $100,000 12%. This book really likes 12%. 8-month note, interest is payable at maturity. What is the amount of interest expense that should be recorded in the year-end adjusting entry if the fiscal year end is December 31st or September 30th? All right, so the first one is July 1st, so all of July, August, September, October, November, December, that's 6 months. So this is simple interest again. 100,000 times 12% times 0.5, because 6 months out of 12 is 1/2. So I got $6,000 for the interest on December 31st. Then I'm going to back this out. So we had $12,000 is our annual interest rate. Now it's what if is it September 30th? So July, August, September, that's 3 months. So now it's 1/4. So I can multiply this by 0.25 and I get $3,000. Check our work. And easy peasy, number 3. All right. Oh, okay, but back to something could be weird. Wayne Corporation issued 12 million of commercial paper on March 1st on a 9-month note. Interest was discounted at issuance at a 9% discount rate. Prepare the journal entry for the issuance of the commercial paper and its repayment at maturity. All right. So what we're going to do is we're going to go ahead and let's just do this in pieces. All right. What's the commercial paper? We issued $12 million. So that is a notes payable for 12 million. Okay. And what is the cash amount we're going to get? Well, we're going to wait on that first because we need to figure out what the discount on the note payable is. All right. So it said we're doing 9% is what it was discounted at, right? So we're going to take 12, 1, 2, 3, 4, 5, 6 times 9%. All right. And then we're going to take that out of 9/12 because it's the 9 months, right? March. So March, April, May, June, July, August, September, October, November. So yeah, it's going to get us all the way to 9 months. So 9 divided by 12 is 75%, or 0.75, I should say. So we're going to multiply this by 0.75. And I got $810,000 is our discount amount. Sorry, discount. And then the rest is going to be what we collect in cash. So let's take 12 million minus the 11,190,000. All right, we'll check our journal entries at the end. All right, record the interest expense on the note at maturity. Okay, we're still calculating interest. Okay, still 9%. So interest at maturity is going to be, where's my calculator? So we multiply by the interest rate, then multiply by the 9/12, which is 0.75. I think we already did this, didn't we? 810,000. We already did this. So we're going to be debiting the interest expense for 810, crediting the discount on notes payable 810,000. So this is recording our interest. We're moving it from the discount to the interest. And then here is record the repayment at maturity. Okay. So we're going to debit our notes payable for the 12 million. Cash, 12 million. All right, let's check our journal entries, see if we got them all right. Yay, good us. All right, next one. All right, Life.com issued 10 million in commercial paper on April 1st on a 9-month note. So April, May, June, July, August, September, October, November, December. That's taking us all the way to the end of the year. Discounted at 6%. And it says calculated discount on the commercial paper. Okay, the annual rate was 6%. The time is going to be 9/12. So doing that is, again, this is just what we've been doing. 9 divided by 12, just to show you that is 0.75 times 6% times 10 million. Discount is 450,000. Okay. The discount 9-month rate. Oh, we're calculating the effective rate. Duh. Okay. So what we need to do is we need to take the discount amount, which was the 450,000 we calculated there. And then the cash proceeds from this note is going to be the 10 million minus the 450. Oops, one too many zeros. So 9,550,000. All right. So our 9-month interest rate is going to be 4.712. And then our conversion factor is going to be the 9/12. No. This is the opposite. 12/9. That's right. To calculate the effective interest rate. That's just the 9-month rate. So our effective interest rate is going to be 4.712 times, can I go in parentheses? I can. 12 divided by 9 out of parentheses equals, I got 6.28. Where does it say to round as one decimal? So let's do 6.3. Get these things off. All right, good. We're good to go on that one. Let's move to the next question. We're almost done. Just kidding, not really, but we'll get there. All right. This next one is, we have in Lizzie Shoe's experience, gift cards that have not been redeemed within 12 months are not likely to be redeemed. Lizzie Shoes sold gift cards for 18,000 during August of 2027. 4,000 cards were redeemed in September of 2027. 3,000 October, 2,500 November, blah, 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 blah. How many gift card revenue associated with August 2027 gift cards sales should Lizzie get to recognize on 2027? So what did it say? It says they're not redeemed within 12 months, are not likely to be redeemed. Okay. So what we're going to need to do is calculate all the ones that have been redeemed. So 18 sold 18,000. I've done there. 4,000 plus 3,000 plus 25 plus 2,000 plus 1,000 plus 500. Oh, it jumped. So minus 15, 13, 12, 11, 5. Okay, so we added basically all of these the 4, the 3, the 25, and the 2 to get 11.5. Then in 2028, we're going to recognize the 1, the 5, and then whatever's remaining after that. So we're going to take 18,000 minus 11,500 and it should be 6,500. There it is. Okay. During December, Rainy Equipment made a $600,000 credit sale. The state sales tax rate is 6%, local state sales tax is 1.5. Journal entry for that. That's all right. This is fine. So we're gonna do sales revenue for I think it was 600,000. So it's 7.5% for sales tax. Sales tax is 45,000. 6, 4, 5, 1, 2, 3. So we're getting cash, and then we're gonna have sales tax payable. Oops. Credit sale, Brian. Credit sale. Read the question, Brian. Read the question. Okay. Das Medical introduced a new implant that carries a 5-year warranty against manufacturer's defects. God, I hope so if this is an implant. Based on industry experience with similar product introductions, warranty costs are expected to approximate 1% of sales. Sales were 15 million, actual warranty expenditures were 20,000. For the first year of the selling product, complete the T account, determine if any DOS should report as a liability at the end of the year. All right, well, 1% of 15 million is going to be 1.5 million. So 1500123. That's our beginning balance. Yeah, I think we're gonna bloody have. Oh, I think what it wants is this to be a 0 balance. And then this is gonna be. No. Where's warranty liability? Oh, I guess this is warranty. So this is bad debt expense. And then this is going to be actual warranties. So 20,000. Let's see if that's what we're looking for. Huh. What is our problem with that? All right, let me calculate this. 15 million times 0.01. Oh, I've won too many zeros. Okay, but my question though is this said bad debt expense was actual expense of bad debt expense, bond payable cash interest payable warranty expense. Oh, warranty expense. I don't know why I put the other one. Yeah, that makes more sense. Look at that, we're halfway done. Consultants notified management of Goo Goo Baby. Oh my goodness. That a crib toy poses a potential health hazard. Council indicated that a product recall is probable and is estimated to cost the company 5.5 million. How will this affect the company's income statement and balance sheet this period? Well, first of all, they better do a recall because if they don't, they could get in trouble for not doing it. So we're gonna have to. Oh, wants it in decimals. I'm gonna say, wait, what do we choose here? Okay, that's gonna be a decrease in net income of the 5.5 million, and our balance sheet will be an increase in liabilities for 5.5. All righty. I'm kind of tired of reading. You guys can pause it and want and read it if you want. Determine the amount of interest expense that should be recorded in the year. Okay. July 1st, 9-month note. Interest rate. This is nice, not giving us a whole lot of data entry points. July, August, September, October, November, December. That's 6 months. 6 divided by 12. July, August, September, July, August, that's 3/12. October, July, August, September, October, that's 4/12. In January of 2028. Okay. July, August, September, October, November, December, January. That's 7. All right, let's do the math. 400 times 0.12 times 0.5. I had 24 million here. 400 times 0.1 times 3 divided by 12 is 0.25. I got 10 million there. 4 divided by 12. I think that's a funky number. Yep. Times 9% times 400. Got 12 million there. Is there a pattern? No, not a good one. Because the interest rate's changing. If it wasn't that, we could have found a pattern. Okay, 7 divided by 12 times 6% times 400. We got 14. Cool. Okay, next one. JWS Transportation Company employees earns vacation. Oh, vacation time. For the appropriate adjusting entry for vacations earned but not taken in 2027. Where's now? There it is. Okay. Is equal to including 4 hours actually taken to, but not including vacations related to taken. So, all vacations earned before 2027 are taken before January 1st, 2027. No rule entries have been made. We're very, let me pull open Excel. I think Excel is going to be a little bit better for us. And so I guess I got a little crazy with that, going a little too far in. All right, so we're looking at finding out what our entry is for the vacations not taken. Earns vacation time at the rate of 1 hour per 40-hour work period. Vacation pay vests immediately. Yeah, okay. Total salaries paid to employees. 4,000 total salaries paid. Why does that matter? 4,000, but not including vacation rate, but be taken to all vacations. Where's the rate of pay? How can we calculate this? So I think what we're needing to do here is take the 404 and we need to subtract out the 4,000 for vacations. And then vacations. So that's going to leave us with a payroll 2027 payroll. 40-hour work week. All right, let's take 1 divided by 40. Okay. And I think this is going to give us how much vacation is left. Or that's what's earned, I should say. And then what was actually taken. So that leaves us 6,000 vacation earned, not paid. So we're going to need to debit salaries expense and credit a liability. Compensated future absences. Let's give that one a shot. Cool. That was kind of a weird one. I was kind of expecting it to be a little bit more muchier. I don't know. That was weird. All right. 11, 12, 30, 40. So 4 more left. Too easy, Drill Sergeant. Too easy. Okay. Bavarian Bar and Grill open for business. No, I'm just gonna read this here. I'm gonna pause the video so I can read it because this one's kind of looks like a long one. Okay. So our journal entry, we're recording the gift card sales sold. We have $5,200. So we're gonna debit cash. Oops, 5,200. And then deferred gift card revenue. And then record redemption of gift cards and meals sold in 2027 and redeemed in 2027. So I probably should have gone a little farther than that, huh? Okay, so we got gift cards totaling 1,300 and the amount of actual meals was 2,100. So let's see if that works for us. 2,100 minus 13. So we got 800 and 4% sales tax. No, not that. It's I gotta do the sales tax on the full amount. So 2,100 times 1.04. So our total amount is 2,184. Okay, I think we got this one. So we're going to debit the cash because we're receiving it, but we don't know how much that one is just yet. If I can spell. And then we're going to be debiting the what we redeemed. So the deferred gift card revenue. And that one we got is told to us 1,200, 1,300. And then we have sales, or what are you going to call this? Sales revenue, and then the income tax liability payable. I mean, sales tax. Sales tax payable. Okay, so the sales tax. So the amount we actually sold was 2,100. And then we calculated it here at 2,184, so 84. And so what plugs is the difference in all this? 2,184 minus 1,300, 884. That's what it is. Okay. Requirement 2, determine the liability for gift cards to be reported on the December. Okay, that's easy peasy. We've got to just subtract what we had out of there. It's 13, 5,200 minus 1,300. Oh, well, hold on a sec. Maybe there's something about the 2 years, 80% are redeemable within 1 year. Okay, so we can do 39 is the liability because it's within a year. What is the appropriate classification of the liabilities? Sales tax. Oh, are we supposed to put amounts in there or something? Um, Are we supposed to put the amounts here? I guess I don't know. What was our amount for sales tax? 84. Yeah, 84. I don't know. Is this? I think it's 0. Oh, wait a minute. Wait a minute. Because of the 2-year redemption of the remaining amount. Hmm. I'm gonna pause the video. I gotta think about this one. Okay, I'm just going with that. I don't think there's anything non-current about the sales tax. I just I don't know. Liability, gift cards, and meals current. This is the one I was thinking of initially, and I need to pull out Excel, I think. So let me get rid of that salaries and vacation stuff. Okay. So we had 5,200 that we sold. We redeemed. Well, first of all, industry experiences, we're going to redeem 80% of it within 1 year. So we're going to, because we redeemed those other stuff. So this is current, but we already redeemed. How much was it? 1,300. 1,300. So 2,860 is going to be our current liability. And then I'm guessing the remaining amount. 1040. This is what I think it's supposed to be. 1040, that's funny because it's the form for individuals for tax. I'm a nerd. Yep, I like it. 2,860 and 1040. 2,860 and 1040. Hopefully that's right, because that'd be cool. Yes. Wong. Okay. Following selected transactions relate to liabilities of Interstate Farm Equipment Company fiscal year end. Okay. On December 15th, we received 7,500 from Bradley Farms towards sale by Interstate of a 98,000 tractor to be delivered. Badly received. Okay. Well, we haven't delivered it yet, so I'm guessing that's not it's like a deposit kind of a thing. So it's going to be some kind of deferred liability. Yeah, deferred revenue sounds right. During December, received 25,500 of refundable deposits related to containers used to transport equipment parts. Refundable deposits. So we receive money. Always do what you know, because even if you don't get the full amount, you get partial credit. Liabilities, something about liabilities. Let's see. Oh, thanks. That's easy enough. Yay. Okay, and the last one during December, credit sales totaled 800,000, and then we got sales tax. Okay, so credit sales. I remember this time. So this is accounts receivable, and we got to calculate the sales tax. So 800,000 times 0.07, 56,000. So 856 Sales revenue 800,000. Your numbers are different than mine. That's why I'm not focusing too much on the numbers. And then sales tax is payable for 56,000. I think I got that one pretty good. Oh, not complete. Is there another requirement? Oh, deferred revenue. I forgot to put that on there. My bad. My bad. Now let's check and make sure it looks good. There it is. There it is. Alrighty. Loss contingencies. Carnes Electronics sells customer electronics carry 90-day manufacturer warranty at the time purchase. Customers are offered the opportunity to also buy a 2-year extended warranty for an additional charge. During the year, King received 412,000 for these extended warranties, and on average, the warranties were 20% expired by year end. Does the situation represent a loss contingency? No. Because remember, right, the selling it separately makes it not a loss contingency. So I'm gonna put no, and hopefully that's right. How should it be accounted for? Revenue is recognized as liability, and warranty revenue. Wait, an asset, I guess. And warranty revenue is computed using the portion to sales. Why would it be revenue is recognized as a liability? That's just weird. I think it's a liability because you're recognizing revenue as unearned until the time period expires, but there's that 20% that expired. It's kind of like a broad question for the whole situation that I don't know that you can really. I hate it when they do that. For the sale of the extended warranties, see if I'm right. 412,000 for the extended warranties. We're gonna debit cash unless it's freaking a credit. Hold on. Said it received, so I'm guessing it's cash. 412,000. And then there's gonna be some kind of liability for extended warranties. Let's find out. There it is. And then record the revenue earned on extended warranties. So we got 20% of it. That's what I'm saying. Like, I don't get what they're saying. We're just dropping the liability and crediting the revenue. So we're gonna do extended revenue, deferred revenue, extended warranties, and then just revenue extended warranties for 20% of the 412,000, 82,400. All right, moment of truth. Oh, shysta. What I miss? Proportionate to the costs. Straight line, I guess is what it was. Okay. I don't know. I thought that was worded weird, so straight line it is. Okay. Last question. Oh man, we're having so much fun. Let's keep it up. Yay. Okay. I'll let that back break. Okay. Sound audio manufactures and sells audio equipment for automobiles. Engineers notified management that 27 of a circuit flaw in an amplifier. Should the loss contingency be accrued, only disclosed, or neither? Okay, so remember that box that I showed you on how to determine whether or not product recall is virtually certain. So we're gonna need to do I'm guessing an accrual and a note as well. Loss contingency should be accrued. The loss, I'm guessing, is 2 million. And the liability will be the same. Requirement 4, record the liability on the product recall. So it's a loss. What we got for loss? Oh, only one. I love it when it's only one, because if you know it, then you know you're good. And then liability, because we haven't paid it out. So let's try product recall. Liability product recall. Yay! I think that's it. Checking my work. What? It's 2 million, isn't it? I'm gonna think of why that 2 million. Oh, are they mad at me because I put too many? Should be entered as 10. I should have put, okay. That's lame. Come on, just program this crap to be what you know. So it should be 2. Well, dumb thing sometimes. I say it's 2 million. I don't know what is smoke in there. All right, that's it. Submit that, and you guys are good to go. We'll see you guys in the next video.